Hey, good afternoon, everyone. We're going to give it another minute or two and let people have a chance to file in. All right, so we are going to go ahead and get started. We do have a lot of information to cover, so I want to make sure that we're able to get through it all. Um, First, I wanted to say good afternoon, good evening, or possibly good morning, depending on where you're calling in from. We are so appreciative of you taking time out of your schedule to be with us for the next 45 minutes to an hour. And for those of you who have not had the pleasure to meet or speak with, my name is Clark Rockway. I am the Senior Manager of Fundraising and Growth Strategy at MPN Research Foundation. And today, I will be your host as we look into shaping the future of MPN research and how planned legacy gifts make a lasting impact. And before we get started, I do want to give you a brief overview of what you can expect to hear about today. And again, thank you for spending your time with us. We're really excited to walk through how planned giving can create a lasting impact for MPN research and patient care. During the session, I'm going to give a brief introduction to MPN Research Foundation, who we are, why we exist, and the mission that drives everything that we do. Then we'll dive into plan giving, what it is, why it matters, the types of plan gifts available, and how easy it is to actually get started. And that's, whether you're planning for the future or looking to make a difference today, we're going to go over all of that. Afterwards, we are fortunate enough to be joined by our guest speaker, Bob Napier. Bob is a leading expert in charitable and estate planning, and he's going to share some insights, strategies, and answer some common questions that we hear from donors. We'll then have a brief Q&A with Bob before we close with a special invitation to take part in our Legacy Challenge, which is basically an opportunity to reflect on the legacy that you want to leave during National Make a Will Month this August. And we're asking everyone here today to consider taking just one step, either by making your first will or by updating your plans to include MPN Research Foundation. Your legacy, it can help us fund research, support family, and shape the future of this community for many years to come. I'd also like to share that today's webinar, it is being recorded and it will be shared with all of you tomorrow. So additionally, if you have any questions, please feel free to put those questions in the chat. We may not have the opportunity to answer all of them today, but we'll most certainly get back to you and follow up and respond to any unanswered questions directly. All right, so let's go ahead and get started about the history and research activities here at MPN Research Foundation. Our beginning stems all the way back to 1997. Robert Rosen, who is pictured on the right, was diagnosed with polycythemia vera in 1997. He actually pulled together the few MPN patients he could find and established MPN Research Foundation in 1999. So we're going 25 years strong at this point. Uh, and though you may already be familiar with our mission, just we focus on stimulating original research in the pursuit of new treatments and eventually a cure for the blood cancers polycythemia vera, essential thrombocythemia, and myelofibrosis, collectively known as MPNs. And we do this through a combination of investing in innovative research, advocating for the patient voice, and convening the global MPN community. We bring together patients, researchers, and industry around the common goal of realizing new treatment options and ultimately cures for MPNs. We are also committed to funding researchers in their quest to treat and ultimately cure MPNs. We're also committed to providing education and resources to patients, their families, and the entire MPN community. By working together, we can effectively change the prognosis and create a brighter future for people whose lives are affected by diseases. And as I just alluded to, at MPN Research Foundation, we are both patient and research centered. We actually have three unique roles in the MPN community that help advance the research mission. First is the research itself. We identify, fund, and support novel research to accelerate the discovery and development of effective MPN treatments. Secondly, we convene. And what I mean by that is that MPN Research Foundation helps to facilitate global engagement across patient and caregiving, research and clinical and industry and stakeholders. And lastly, we advocate. We help to advance patient perspectives and address researcher challenges in discovery development. But as you know, we can't do this alone. We do have a wonderful community dedicated to helping one another and to advocate, which is huge as we move forward. That's just a very brief history as to who we are as an organization. But we are also always looking towards the future, which brings us to plan giving. And plan giving is exactly what it sounds like. Just planning your giving in a way that aligns with your values, your financial goals, and your long-term vision for impact. It refers to charitable gifts that are built into your financial or estate plans. Some of these gifts are designed to support a cause after your lifetime, or others can actually be put to work right now for today. But in both cases, the key is intentionality. Uh, these types of gifts are often deeply personal, so they allow you to honor your values, honor your legacy, support your family's financial needs, and invest in something bigger than any one of us, the future of MPN research and care. So whether you're planning ahead or giving from what you've already set aside, plan giving gives you the chance to create lasting change in a way that works for you. And when we talk about plan giving, it's helpful to know that it generally falls into two categories. Uh, Gifts that are future focused and gifts that can be put to work today. For future focused gifts, that includes things like a bequest in your will or trust, naming MPN Research Foundation as a beneficiary of a retirement account, life insurance gifts, or charitable remainder trust, which provide income now and a future gift later. These these gifts typically take effect after your lifetime, but they allow you to leave a powerful legacy and one that really reflects your values and support the mission long term into the future. Planned gifts for today, however, are a little bit different. These include things like qualified charitable distributions from IRAs, donor advised funds, which grant or successor gifts, uh, gifts of appreciated stock or real estate. All of these are very tax smart ways to give now and can have an immediate impact on our ability to fund research, support patients, and move our mission forward in 2025 and beyond. Now, each path offers unique benefits, whether that's tax saving, income options, or flexibility. And every one of these, every single one supports life-changing research that can and care for people living with MPNs. So when people think about giving, they often think in terms of cash, writing a check or making a donation online. But the reality is that 95% of the nation's wealth is actually held in things like property, stocks, and retirement accounts. Only 5% is cash, which is why plan gifts are so powerful. Uh, Plan giving, it allows you to make a meaningful difference without writing a check today. It can come from your will, your IRA, or other assets you've already set aside, and it lets you support the causes you care about in a deeply personal, lasting way. Additionally, planned gifts are mission critical for advancing NPN research and support over the long term. They give us the ability to plan ahead by funding long-term research, support patients consistently, and move the mission forward no matter what else is happening in the world. The truth is, NPN research doesn't receive the same level of federal or institutional funding that other diseases do. The progress that we make depends on the generosity of individuals such as yourself who believe in what we're building. So when you include NPN Research Foundation in your plans, which again we invite you to do today, you're doing more than just leaving a gift. You're helping to secure the future of research, advocacy, and hope for the NPN community. Now moving on to future focused plan gifts. Let's start with one of the simplest and most meaningful ways to make a lasting impact, a bequest. This is a gift that is made through your will or trust, and it allows you to support the future of MPN research without affecting your finances today. You can leave a specific dollar amount or a percentage of your estate or a particular assets, and it's fully revocable, meaning that you can update it at any time. Plan gifts like these are critical to our mission long term because they give us the ability to fund extended research initiatives, support patient programs, and invest in areas where grant dollars simply don't reach. And this isn't just for wealthy donors. Many of our most impactful gifts have come from people who've left just 5% of their estate after their family was taken care of. So even a small bequest can help ensure that the research continues and that people living with MPNs are supported for years to come. One of the other big surprises for a lot of people is how easy it is to actually include a nonprofit in your will. You don't need to start from scratch or rewrite everything. Just a simple conversation with your attorney or advisor can make that happen. And in many cases, all it takes is a short update called a codicil. It's quick, it's affordable, and it puts your intentions into writing. You can leave a specific dollar amount, a percentage of your estate, or what's called a residual gift, which is simply what's left after your other priorities are taken care of. Now, if you've already included MPN Research Foundation in your plans, we hope that you'd let us know. This gives us the chance to thank you and make sure we fully understand your intentions and your wishes. But of course, if you prefer to stay anonymous, we'll absolutely respect that too. Um, but overall, this kind of planning doesn't have to be complicated. It is, however, incredibly impactful. Now, if you are ready to take that next step or even just start the conversation, here on the slide is some language that you can share directly with your attorney or advisor. It's straightforward, it's flexible, and it ensures your gift is used where it's needed most to fund research, support patients, and help us move closer to a cure. This is what we call an unrestricted bequest, which gives MPN Research Foundation the ability to direct your gift to the most urgent priorities at the time that it's received. Our federal tax ID is also listed here as well, and if you have any questions at all, we're happy to help. Please feel free to reach out to our team directly or just let us know that you'd like to follow up after the webinar. And to make it easy, Kylie, my peer Kylie, is going to be dropping our plan giving resources in the chat right now. You'll find everything you need to get started, including sample language and tools to help you talk to your advisor. If you believe in this mission and you want to leave something meaningful behind, this is one of the most lasting ways to do that. Another very straightforward way to leave a legacy is by naming MPN Research Foundation as a beneficiary of your retirement account, like an IRA or a 401k. It's a simple form, not a legal process, and it allows these tax-deferred assets to pass directly to charity, completely tax-free, while also potentially reducing estate taxes for your heirs. This is one of the most efficient legacy gift options out there, and we'll talk a bit later about how IRAs can also be used for current giving, especially if you're 70 and a half years of age or older. There's a way to make a tax-free gift now, not just in the future. But Bob is also going to be going into more details here in just a bit when we hear from him. Now, another option that many people don't think of is life insurance. If you have a policy you no longer need or one you originally took out to protect a loved one who are now financially secure, you can always turn that into a legacy gift. So you can name MPN Research Foundation as a beneficiary of your policy or even donate an existing policy directly. Surprisingly easy process, usually handled through your insurance provider. This kind of gift can also create a large impact at relatively little cost to you. And because it doesn't affect or impact your day-to-day finances, it's one of the most accessible ways to leave a lasting legacy. It's a simple step that can fund future research, support patients, and extend your values well beyond your lifetime. Now, this option may be a little bit less familiar, but it's also a very powerful tool, especially if you're looking to create both impact and income. A charitable remainder trust, or CRT, lets you support MPN Research Foundation while still providing income for yourself or a loved one. Here's how it works. You can contribute cash, stock, or other appreciated assets to the trust. You or someone you choose receives income from the trust for life or a set number of years. Then, once that term ends, whatever remains, it goes to support MPN research and patient programs. This kind of gift can greatly reduce estate taxes. It'll help you avoid capital gains on appreciated assets and provide meaningful support for a family member or spouse. In short, it's a way to take care of someone you love while also making a lasting difference in the MPN community. Uh, So we've talked a little bit about, some of the different future focus plan gifts, but also want to discuss some of the pitfalls of not naming a beneficiary. It might seem like a small detail, but it can actually have major consequences. When no beneficiary is listed, for example, on an IRA, life insurance policy, or retirement plan, those assets typically go to your estate by default, and that triggers a cascade of very avoidable issues. First and most importantly, you lose control. Your assets may not go to the person or cause you would have chosen. Instead, state laws or default policies may decide for you. Second, those assets are now subject to your estate's debts. Creditors get paid first, which can reduce or even eliminate what goes to your loved ones or charitable causes. This process also takes time and money. Probate can cost anywhere between 2% and 7% of your estate's values, and delays can stretch on for months, sometimes even longer. And finally, then there's the tax impact. In many cases, retirement assets passed through an estate may face full taxation within just 5 years, significantly reducing the value of the gift. The result? Fewer dollars reach the people or organizations you care about, and more is lost to taxes, delays, and process. The good news, however, is this is very simple and easy to fix. Naming a beneficiary is fast, flexible. In most cases, it can be done online in just a few minutes. Whether you want to support your family, your values, or a cause like MPN Research Foundation, this one step ensures your gifts reaches its full potential. Donor advised funds. So if you already have a DAF or a donor advised fund, it's a great way to give flexibility and make an impact terms. A DAF works like a charitable investment account. You contribute when it makes sense for you and receive an immediate tax deduction. Then you recommend grants to organizations that you care about, like MPN Research Foundation, over time. It's simple and easy to use. Most providers like Fidelity, Schwab, and Vanguard offer easy online tools to make a grant in just a few clicks. And if privacy is important to you, you can even make those grants anonymously. What makes DAFs especially useful is that they let you separate the act of giving from the timing of the grant. You give when you can and you grant when it's needed. In fact, on the next slide, we'll walk through a quick example of how you can front load a donor advised fund to make an immediate and a long-term impact. So this is a great example of how a donor advised fund can be used strategically, not just to make a gift, but to really plan for long-term meaningful impact. Let's say that you're someone who typically gives $10,000 a year. If you give that amount annually, it may not be enough to exceed the standard deduction, so you don't receive any tax benefit from those gifts. But by contributing $40,000 to a DAF in a single year, you bunch your giving into one big giving year, one where your charitable deduction does exceed the threshold and provides real tax value. From there, you can spread out your giving over time, 10,000 this year, 10,000 next year, so on and so forth. The same total gift, but structured in a way that maximizes your deduction and allows for more intentional grant making. It's not transactional giving. It's very strategic. You're front loading your generosity to benefit both your financial goals and the causes that you care most about, such as MPN research and patient support. Now, with qualified charitable distributions or QCDs, if you're 70 and a half years of age or older and have an IRA, this is one of the smartest and most immediate ways to give. It allows you to make a direct gift from your IRA to a nonprofit like MPN Research Foundation completely tax-free. This kind of gift is also known as an IRA charitable rollover. The money never passes through your hands. It goes directly from your IRA to the nonprofit. So it doesn't count as income and doesn't increase your tax liability or your tax burden. Even better, it satisfies your required minimum distribution for the year. So if you're already taking distributions from your IRA, a QCD lets you fulfill that requirement while supporting a cause you care about at the right time. It's a very powerful way to make an impact right now, especially if you're looking to give before the end of the year. Uh, Going more into IRAs and QCDs, this is a very simple way to look at how your retirement account evolves over time and where giving fits in at each stage. In the early years before age 59 and a half, any withdrawals are considered early distribution, which often come with penalties and added tax consequences. So this usually isn't the most strategic time to give directly from one of your retirement accounts. Once you reach age 59 and a half, however, you can take regular distributions without penalty. And at this stage, some donors choose to give from these distributions if it makes sense for their tax picture. The real opportunity, however, comes at age 70 and a half and beyond. And that's when you become eligible to make qualified charitable distributions directly from your IRA completely tax-free. And those gifts count towards your required minimum distribution or RMD. So whether you're still in the egg stage or fully hatched, there is a very smart way to give at every point in the life of your retirement account. Now, once you turn 73, you are required to start taking minimum distributions from your IRA each year, which, as I just referred to, these are required minimum distributions. The amount you have to withdraw is based on your account balance and your life expectancy. And if you don't take the required amount, there is a steep penalty, 25% of what you're supposed to withdraw. Say that your RMD this year is $10,000. If you take that as income, it's fully taxable. But if you direct that $10,000 straight to a nonprofit like MPN Research Foundation as a qualified charitable distribution, it satisfies your required minimum distribution and avoids the tax. So it's a smart way to give, reduce your taxable income, and make a real difference, especially for those of you who are already at this stage or getting close to it. Now, if you are over 73 and you're required to take a distribution from your IRA, but don't actually need the income, some people wonder if they can just take it, donate it, and then deduct the gift to offset the taxes. And the answer is maybe. If you itemize your deductions and you're under the income limits and the gift doesn't push up your adjusted gross income in a way that triggers penalties or phase outs, and depending on the state that you live in, then yes, that charitable gift might offset the income. But as you can tell, that's a lot of ifs and not very straightforward and quite confusing. That's why we recommend the qualified charitable distribution route when possible. It's simpler, it's cleaner, and it's more reliable, especially if you want to give now and reduce your taxable income directly. That said, always talk to your advisor about what makes the most sense for you. This slide shows why qualified charitable distributions are such a powerful tool for those giving over the age of 70 and a half. When you use a QCD, the money goes directly from your IRA to organizations such as MPN Research Foundation. And again, because it bypasses you completely, there's no income added and no deduction needed. It's just clean $0 income, $0 deduction, and no tax reporting headache. Satisfies your required minimum distribution, but doesn't increase your taxable income. So it's especially helpful if you're concerned about things like Medicare surcharges or potentially bumping into a higher tax bracket. This is one of the rare cases where simple is smarter and a really effective way to support MPN Research Foundation while reducing your tax burden. Now, moving on to appreciated stocks. This is also one of the most tax efficient ways to give, especially if you've owned shares that have significantly grown in value. When you sell those shares yourself, you pay capital gains tax on the growth. But when you donate them directly to a nonprofit, you avoid those taxes entirely and still get a deduction for the full fair market value of the stock. That means you can give more at less cost to you, and your gift has greater impact. Is especially helpful for your year-end giving for one-time high-value gifts, or if you're looking to hold on to appreciated stock and looking for a smarter way to use it to do good. And if you're not sure how to do this, don't worry. We are always happy to talk you through the process. This is a great example of how giving appreciated stock can be a smarter, more cost-effective way to give, especially if you itemize your taxes. Let's say that you want to make a $100,000 gift. If you were to give that gift in cash, you'll get a charitable deduction, and let's assume you're in the 37% tax bracket, so that's a $37,000 tax benefit, and the true cost to you is about $63,000. But the second option is donating $100,000 worth of stock, not cash, and that's grown in value over time. And let's say that it originally cost you $10,000. You still get that same $37,000 deduction, but you're also going to avoid paying capital gains tax on the $90,000 in growth, which is an additional $21,000 in tax savings. So your total out-of-pocket cost, just over $41,000. Same impact for MPN Research Foundation, but at a much lower cost to you. It's a perfect example of how asset-based giving isn't just generous, it's very strategic. Now, moving on to this slide, we can see why appreciated stock can be a smart choice even if you don't itemize your deductions. At the top, we see a donor again making a $100,000 cash gift, but because they don't itemize, they don't receive any tax deduction, so the 100,000 is fully out of pocket. But if that same donor gives $100,000 in appreciated stock, they still can't deduct the gift, but they would avoid paying the capital gains taxes on the stock growth. So in this case, as we just kind of talked about in the slide before, that's over $21,000 in tax savings. So the net cost of their gift is around $78,000 instead of the full $100,000. And that's the value of giving stock. Even without the deduction, it can cost you less to give more. And a gift to MPN Research Foundation still has the same incredible impact. So I know that's a lot of information. At this time, I'm going to be passing it over to our keynote speaker, Bob Napier, who I'm very thrilled to have on the call with us. He is the managing partner at Harrison LLP and a nationally respected expert in estate and charitable planning. He's helped individuals, families, and foundations structure meaningful gifts that reflect their values while also protecting their financial future. And before joining Harrison, Bob ran his own firm in Chicago for nearly 20 years. He administered countless estates, some very straightforward, others very complex, and brings a deep insight into what works, what matters, and what to avoid when thinking about legacy. Bob, we're very glad to have you here with us, and the floor is yours.
Thank you so much, Clark. Can you hear me okay, Clark?
Yes.
Great. Well, I want to thank you and Jennifer and Kylie and Kapila and David Ritchie for the chance to say hello. I think what you're doing is just awesome work. And I will say I'm a little embarrassed by how thorough and awesome your presentation was, because mine may disappoint because you set the bar so high. So apologies in advance for that. You know, you're mentioning some mistakes, and I'll start out with a few slides that I think are things that are overlooked. Maybe I'll call them the don'ts. But I thought of a couple more when you were presenting your excellent presentation. And I wanted to share those now only because they're minor, but I'll share with you why I think they're so important. The first is that if you want to make a gift of stock to MPN Research Foundation, you want to make sure that that stock has been held for at least 1 year. Otherwise, the IRS will only give you a tax deduction of the cost that you paid for the stock. So if you bought a stock that was 85 bucks, I'm thinking of NVIDIA, if you bought it at 85 bucks 2 months ago and it's now 145 or whatever it is, and you want to give it away to MPN Research, IRS will only give you a tax deduction based on the $85 you spent for that share of stock. Interestingly as well, and I smile at this because I'm so concerned or confused by it, the IRS will always ask, not always, but often ask to see a copy of the tax receipt letter that MPN Research will give you when you make a donation. And you may think, well, that's kind of petty. And I thought it was very petty as well. There was the guy who did Hewitt Associates, or Hewitt, not Associates, but Hewitt Tax Preparation. Mr. Hewitt, the IRS asked for the letter, a similar letter from him. He didn't have it. He lost his charitable deduction. So I share that with you only because it's strange to me that they would be so gleeful to take away someone's deduction who was philanthropic. So with that, I want to thank each of you who are on this call, because you have, to a great extent, overcome, at least for the moment, the biggest friend the IRS can have, and that's inertia. Inertia is also the biggest friend that your former son-in-law or daughter-in-law can have in estate planning. It's also the biggest friend any creditor you may have in the future may have against you, because inertia means that you haven't looked at your estate planning. And some people lament that, boy, I wish I had done my estate plan more frequently. I equate that to going to the dentist. The reality is you can't blame the dentist if you don't go to the dentist more frequently than every 5 or 10 years. You've got to see your estate planning attorney, typically more, maybe not as frequently as you'll see the dentist, but still pretty frequently as well. Another thing that Clark hit on so well is missing beneficiary designations, not only on retirement accounts, but also life insurance. We see it. And I was also remarking, all the veterans that may be watching this, imagine if your VA life insurance benefit of, I think it's 10,000, maybe it's $20,000. If that was named to be MPN research, how cool would that be? You served your country, and your country thanks you by endowing a bit of a gift to MPN research. I think that's a neat idea. I've not seen it done, but I don't know why we've not seen more people do it. But interestingly, on the retirement account beneficiary designations, my paralegal and I were chatting this afternoon, and we were both commenting that so often what you think is so straightforward, that is these beneficiary designations being done thoroughly and thoughtfully, the reality is they're often overlooked. And interestingly, if the custodian of your retirement account changes computer systems and somehow loses your beneficiary designation, it's not its fault, it's your fault, because your beneficiary designation now doesn't exist. So we don't know what you wanted to do. So it's incumbent, I think, upon those people who have retirement accounts that they check them to make sure that the beneficiary designation is current and reflects their wishes. The next thing, again, Clark, you did such a great job on this one. The next thing is looking at involving the IRS. And what's so important about this is many people will, I think there's a statistic on this, and I wish I had it for you. Something like 80% of all philanthropic gifts, the number's not accurate, but the point is the point of the statistic. Like 80% of philanthropic gifts are made in cash, which is the least efficient way to be philanthropic. And we all like the idea of being, I hope, philanthropic, but it's also nice if someone else underwrites your philanthropy. So I have this picture of the IRS commissioner. This is a past IRS commissioner. I don't know if you can bring him up or not, Clark, but that's the inertia, by the way. The point of that big rock was that if this ancient Peruvian civilization up in the mountains can move a rock of that size, twice the size of the rocks at Stonehenge, we should be able to overcome the inertia of not addressing our estate planning and philanthropic goals. So that was the point of that picture. I got a kick out of sharing that one with you, but I also got a kick out of sharing with you this picture of the IRS commissioner. He's no longer the commissioner, but I thought it would be fun to envision having this guy over to dinner at your home and tell him we want to involve the IRS in our philanthropy because that makes our tax giving that much more efficient. Clark truly did a phenomenal job in highlighting exactly the ways that we do that. And you think, well, that was pretty straightforward. Clark did a bang up job on it. Why don't all of us do that? Well, I don't know. We too often make these cash gifts that don't get underwritten by the IRS. And the reality is the government encourages us to make these gifts because that lessens the burden on the government to make similar gifts. And to Clark's earlier point, that the government may not fund this type of research that's so important to us, but this research is important to us and everyone on this call. So why not let us decide where our dollars go to work rather than sending our money off to Washington and having Washington decide on where those funds get deployed. MPN research will get more if we are active as opposed to if the federal government is active in that regard. So another one of the sort of the don'ts, if you will, sort of the mistakes I think that people make, and this is subjective, you might disagree, but it's lifetime gifts. And so often, I wrote a newsletter once, and I said those people reading this newsletter might think of me as Scrooge because I was making a point about the importance of making lifetime gifts and not putting them necessarily in a testamentary document. A lot of people will come to us and we'll read their estate plan and it will say, I give $500,000 to MPN research upon my passing. And that's beautiful and that's lovely and it's generous. But I'll ask folks, what do you think about making that gift during your lifetime? And the reason why I share that is, and it's almost kind of selfish, because how wonderful, how rewarding to actually see your money put to work. Just imagine that you were the person who walked the check in to the offices of 10,000, 100,000, whatever the dollar amount was, and put it on the desk and saw the look on the face of the person or Clark or Kapila or whomever took this check. Just think how you would leave their office just ecstatic. There have been studies in Switzerland and the University of Texas about the dopamine that's released when we see our money put to work. And I'll share a story with you. It's a little emotional for me. A lot of this is emotional for me. I had a client, he's actually had a street named after him in Chicago. And at his demise, he left money to send inner city children to university. And he was gone. So I was the guy who sent those checks out. And I received countless letters from students thanking me for sending them to college. And I thought, wow, I don't deserve the hugs, if you will, that came from these correspondence. The fellow who earned the money and gave that to these kids who could be the first in their families to go to university deserve the hugs. And I think it's you who deserve the hugs when it comes to MPN Research Foundation. So, well, as much as I like making gifts in a testamentary way, that is in your will or your trust, I really love the idea of you getting the hugs. And the beauty is, our IRS commissioner from the prior slide is actually gleeful as well. So not only do you get the hug, but also the IRS commissioner is happy because he gets to have the Treasury's responsibility to fund other research minimized. And you've got the government underwriting your generosity because, to Clark's point, if you give $5, $10, $100,000, whatever, during your lifetime to MPN research, that comes off your tax return. That you can deduct as high as 37%. You don't realize the capital gains that would have been realized on the sale of that stock, as Clark's document pointed out. And you also avoid that 3.8% net investment income tax. So the government's paying some substantial portion of your philanthropy. And I think that's just a fantastic win-win for everybody. You, the government's happy, and MPN research is even more happy. So let's talk about some of the things that people can do and that I think are sort of underutilized. This Clark hit it so well. The qualified charitable distribution, or QCD, that is capped at $100,000 per year. Interestingly, that number is indexed for inflation. So today in 2025, that number is now $108,000. So if you're over 70 and a half and you like MPN Research Foundation, you can have your custodian, Fidelity, Vanguard, Goldman Sachs, whomever, send up to $108,000 to MPN Research directly. Now, a couple thoughts on this. The first is, you might say, that's too much money for me. I don't know that I can afford it. You can send as little as $100, I suspect. Maybe there's some minimum with Fidelity or Vanguard, but the reality is you can transfer some amount that you're comfortable with less than $108,000. Similarly, your spouse can also, if they're qualifying and that is over age 70 and a half, send up to $108,000, and it just completely bypasses your tax return. So it's a delightful way to, in a tax efficient way, keep your income lower, which is better for Social Security and, of course, not bumping you up into higher income tax rates, and still satisfying the importance of supporting MPN research. So that's wonderful. The testamentary planning, you've got to love it. I mean, there are smart ways to do it, and there are ways that are a little less sophisticated in doing it. But the testamentary gifting in your estate plan is really important. I think too often it's overlooked. When we see gifts of $10,000 or $25,000 in someone's estate plan, I'll often say to them, you know what, if you feel comfortable financially, let's take that out of the estate plan and just make the gift right now. And that's when I worried that people would think of me as being Scrooge, because who on earth says, take this charity out of your estate plan? Well, we're not really taking them out of the estate plan. What we're doing is accelerating it and having the government underwrite our generosity, because A gift made in a testamentary plan may not, to Clark's earlier point, generate any tax savings for you. This is fascinating, I think, but I'm a strange guy, so you may not find it as fascinating as me. But with a $14 million, well, it's actually $13.99 million federal estate tax exemption today, that exemption is scheduled to be cut in half come the end of the year unless this tax bill that's bouncing around Congress passes. Because that number is so large, this is surprising. Only 3,000 people a year, or states really, pay federal estate tax. Back in the 70s, that number was 80,000, almost 80,000 people, and the country was about half the size that it is today. So very few people pay federal estate tax. And it's interesting, our law firm has 100 estate planning attorneys in 12 different offices. I'm talking to you from our Naples office, and we see many, many taxable estates come through our office, but the reality is very few people do. Federal estate tax applies to very, very few people, but curiously, many states, about a dozen states, have their own state estate tax, which we'll chat about in a moment. And there's also a thing called an inheritance tax. States like Pennsylvania tax you if you inherit wealth from some other person. An inheritance tax differs from an estate tax. But let's talk a little bit about IRAs going to charity. And this is something that we just, whenever we see a successful family, we say, what are you thinking about the IRA going to a surviving spouse? We understand that. But why is the IRA going to the children? Because a lot of things happen that may be unintended. And I'll paint one example for you before we get into this more complex one that we'll end on. Imagine a husband and wife have $1 million IRA and they've got one son, he's 18, and husband and wife passed away yesterday. Now this 18-year-old son who was named as the contingent beneficiary of an IRA, he's now an 18-year-old with $1 million at his disposal. Think of that. Most people, I should say most males, with apologies to those males on the call that this doesn't apply to, might be quite imprudent at age 18 if they had $1 million at their disposal. So in other words, I've had some parents say, I would rather my 18-year-old didn't get any money because it could be so damaging to that individual. So that's an unintended consequence that we often look at when we see IRA beneficiaries. Almost immediately we see, even if the kids are 12, 16, and 18, we'll still see kids named as IRA beneficiaries, and we don't like that at all. We especially don't like it on this example I'm going to share with you right now, and we'll close on that one. Imagine a hypothetical. This is the one with the toll booths, Clark, if you see that guy. The reason why we look at retirement accounts is because they are going to be savaged. And I'm going to beg your indulgence here. I'd like you to imagine, if you would, Tom lives in Chicago. He's got one daughter. He's single. Her name is Monica, let's say, and Monica lives in New York City. And so envision on the left side of the page on the slide that Clark's put up, that's where Tom lives in Chicago. All the way on the east side, the right side of the page is New York City, where Monica lives. And Tom's worth $20 million. Of his $20 million, $5 million of that, now let's make it simple, $1 million of that is his IRA. And of course, he loves Monica. He loves MPN research. Let's not be unclear about that. Tom loves MPN research, but he loves his daughter Monica even more than MPN research. So he says his entire estate goes to his daughter Monica, who's a fancy Goldman Sachs investment banker in New York City. So let's just focus on the $1 million IRA, since I'm making such a big deal about retirement accounts here. Now, work with me, if you will, here from the left side of the page. We have to send that IRA through these toll booths, and there's many of them. By the way, if you wonder if AI is good for stuff, I had said to AI, give me a picture of a bunch of toll booths in a row. And this is what it gave me. So I took the first thing it gave me. So the first toll booth on the left, that's the federal estate tax that Tom's $1 million IRA has to work its way through. So the IRA walks into that first toll booth. The federal estate tax is a flat tax. People have been lobbying, Steve Forbes and others lobbying for flat tax. It's a wonderful thing. Well, tell me how wonderful you think a 40% federal estate tax is for this fella, Tom, hypothetical guy. His $1 million IRA owes effectively 40% or $400,000 to the federal estate tax. So the IRA exits the first toll booth on the left, stumbles to the second toll booth on next to the federal estate tax toll booth. That's the Illinois, because remember I said that Tom lives in Chicago. So Tom has to pay a state estate tax, Illinois being one of the dozen or so states with a state estate tax. And that tax starts at 16% and goes down to 8. Let's just say, for the sake of simplicity and sanity, that we're going to put the state estate tax payable to Illinois at 10%. It's probably higher. So now we're at 40% federal, 10% state. This $1 million IRA that's making its way across these toll booths is kind of feeling a little bit woozy. It's not going well for him. He's getting pummeled every time he enters the new toll booth. But of course, Monica is this big shot investment banker at Goldman Sachs in New York City. Of course, all of this is painted to show these numbers more drastically. And I acknowledge with only a bit of humility that the examples are a wee bit tortured, but it's just fun to see the significance of all this. The federal estate taxes, or sorry, income tax, the third tax there in that toll booth, the federal income tax is at 37% on the maximum side. So yeah, you see these numbers adding up quickly, don't you? And then we wisely or interestingly put Monica living in New York State. New York State's got an estate tax of somewhere around 10%. And I had to put her in New York City because the New York City tax is also out there, which takes us over 10%. So let me add these taxes up for you just for the sake of fun. 40 federal estate, 10 state estates, so now we're at 50. Federal income tax is almost 40, so now we're at 90. New York tax, income tax, we put about 10, so now we're at 100. Local income tax, let's just call that 4, so we're north of 104. And you might say, oh, if there's any accountants on the call, you're saying, well, Napier, you're overstating the fact that I can deduct the federal estate taxes on my personal 1040. Yeah, that's true. That might lower the estate tax rates or the cumulative tax rates of all this to something less than 100. But have I not made the point anyway? And remember, if I had changed these facts, this is interesting. We don't see it too often, but we do see it. Imagine that Tom said about his daughter, Monica, that she was so successful as a fancy investment banker in New York City, she didn't need the money, but her daughter, Susie, that is Tom's granddaughter, could sure use that because after all, she's only 10 years old or something. If Tom had left that $1 million IRA to Susie, it's conceivable that even another tax could be assessed called the generation skipping tax, which would throw on, brace yourself, another 40%. So we don't see that happen too much, but we do see all of these taxes being paid. And it's human nature to look at our IRA accounts on our financial net worth statements and say, oh, good, I have a $100,000 IRA, or I have a $1 million IRA. Well, not really, because there's a tax liability like a barnacle affixed to those retirement accounts. So instead of all of those toll booths, how wonderful, as we pointed out in the earlier slides and as Clark emphasized, how wonderful if the family can afford it financially and there's no estate tax considerations, even if there are, certainly if there are estate tax considerations, to name MPN Research Foundation as perhaps a contingent beneficiary behind a spouse, or we have many circumstances where the spouse says, look, I don't need that retirement account. We're very well off. Why don't we just name MPN Research as the primary beneficiary of that retirement account? And what happens in that result? All of those toll booths are completely bypassed. The IRA walks around those toll booths, knocks on the door of MPN Research, and deposits itself on the desk, and exactly no federal taxes are paid, exactly no state taxes are paid, and every last penny of that IRA goes to make the world a better place. So that's why we so often emphasize any successful clients like Tom. We've got this massive balance sheet, 20 million or more. Anything beyond the federal state tax exemption of currently 14 million bucks, you save a mountain of money. And with that, I'll close. When I first met Clark, he said, Bob, talk for 30 minutes. After Clark met me, he said, Bob, no, talk for 15 or 20. So he was trying to keep me away from you, and I don't blame him. I want to share with you a quote from Elizabeth Kubler-Ross. I don't know if you can read it, and I'm going to read it for you. The most beautiful people we have known are those who have known defeat, known suffering, known struggle, known loss, and have found their way out of the depths. These persons have an appreciation, a sensitivity, and an understanding of life that fills them with compassion, gentleness, and a deep, loving concern. So I can't see any of the 80 or 100 of you on this call, but I do know one thing: you're beautiful people. So thank you.
Thank you so much, Bob. Really appreciate that. Thank you for all your insight. In the interest of time, for the Q&A section, I think we're going to keep it to two questions. So the first one that I have is, how do you recommend donors talk with their family about leaving a gift to charity in their estate?
Well, it's a great question, and it's become sort of a topic that we estate planners are hearing more about now. And I get the question a lot. A couple things. The first is Warren Buffett. Warren Buffett's dad, you may have read about this in the Wall Street Journal or elsewhere, brought the family in and explained to them, look, this is how the estate plan is going to go. And Warren appreciated that. And now Warren has let his kids know that, they're going to have to somehow figure out how to get by with only a few billion because the rest of the billions are going to be going to charity. So the family all knows that. And that's an easy message to convey when you're Warren Buffett. I will tell you that many people have said, hey, I want you to meet my family. And we meet the family, and then the dad says, kind of in a business-like way, well, this is all what's going to happen when I'm not here. And all of a sudden, boom, people collapse because it's emotionally incomprehensible that dad would say such a thing in front of his kids who are now emotionally gone. But the point of Warren Buffett's advice and the point of that dad hypothetical CEO type guy in my example is that surprises can generate disappointment. Disappointment can generate a phone call to a lawyer, and the lawyer says, well, gee, maybe I'll file a lawsuit with you and make myself a lot of dough too. And if we lose, we lose, but the lawyer gets paid. So I think disclosure as to the importance of philanthropy is good from a business perspective. I also like it from an emotional perspective because it lets the generations that follow know what's important to the patriarch and matriarch. That is not necessarily acquiring a new Birkin bag, not necessarily going to St. Bart's, and no knock on St. Bart's or Birkin bags, but it lets people know that the important things in life are leaving this place better than you found it. And that's what philanthropy does. And it makes people realize, gee, this is not necessary for me to keep up with the Joneses. It is necessary for me to take care of people and to ease the pain and suffering that others are enduring. So I like the idea, and it's now become a topic that we're hearing more and more about. It's a great question.
Couldn't have said it better. And then finally, also see if I already have a will or a trust, what's involved in updating it to include MPN Research Foundation or another nonprofit?
Okay, so we get this question a lot too, and interestingly, I will divert them from dealing with me for the reasons I just articulated in that slideshow with the toll booths. Here's why, and this is against my own self-interests. Um, if you go to Fidelity or Vanguard or Goldman Sachs and say, hey, my spouse doesn't need the money, or my spouse has passed away and I don't want to send my IRA or retirement accounts. By the way, when I say IRA or retirement accounts, I'm exempting Roths. Roth IRAs are very tax advantaged. They're expensive to get into. Typically, they're not very large, but we do not earmark Roth IRAs for philanthropy. We earmark traditional retirement accounts. So, Clark, what I'd like to do is point people to go to their custodian and make the change there because they don't get a legal bill. Whereas if someone comes to me and they've got a 5 or 7 year old estate plan and I have to update it for them, I can't just do the one paragraph that they want always. Sometimes I have to bring the rest of the estate plan current. So some clients will say, oh, shucks, I don't want that. I want only this one paragraph added. Well, the reality is if I go to GM and to buy a new Chevy, I've got to get a 2025 model Chevy. I can't, Chevy can't let me leave with a 2018 model Chevy. That may be a bad metaphor, but you get my point, I hope. The idea is that we estate planners have to keep our clients current, not only on their philanthropic goals, but also on the tax language. Tax laws on the federal level and state level are changing all the time. And believe it or not, we were chatting about that with Jennifer earlier before the meeting started. You think that you build your estate plan 5 years ago and it's good to go for a decade or two. Not so fast. Think of it more like the trip to the dentist. You've got to stay current with it. And if you don't stay current, though, that little refresh can be more time consuming, but it's far more protective for your family. But if you bring all the facts to your estate planning attorney, whoever he or she may be, they'll be able to simply put in the MPN Research Foundation language, and then to your service, to your advantage as well, bring the rest of the plan up to speed and make it current.
Perfect. Awesome. Thank you so much, Bob. Really appreciate you taking time out of your day to, speak to all of us and answer some of these questions. Again, those questions that we did not get to, we will be following up with you individually. But thank you, Bob, for your time. I do have a few more slides, so in the last 5 minutes, I'm going to get to those real quick. So to recap how to get started, do want to take you through getting started with legacy gifts for the future. It's four simple steps. Step one, choose how you'd like to give. That could be a gift in your will or trust, naming MPN Research Foundation as a beneficiary of your retirement account, a life insurance policy, or a donor advised fund. Step two, as Bob kind of alluded to, is to meet with your advisor. A quick conversation with your financial planner or attorney is usually all it takes to update your plans. Step three, and this one's very important, is to let us know. If you've included MPN Research Foundation in your plans, with us, it allows us to recognize your legacy and make sure your intentions are honored exactly as you envision them. And then step four is stay connected. We'll keep you updated on the impact of your future gifts that it'll make and the progress that you're helping drive forward in NPN research and patient care. So even if you're not ready to make a change today, having this conversation and making a plan is one of the most meaningful steps that you can take. Now, changing gears to making to gifts for today and making an impact today. Here's how you can get started. Again, same four steps. Step one is to review your giving options. You can talk with your advisor or reach out to us to explore donor advised funds, IRA distributions, or gifts of appreciated stock. Each option has its own unique benefits. We're happy to help you find the right fit. Step two is to make your gift. DAF grants, QCDs, and stock transfers are usually very simple to complete. Many just take a few clicks or a short form submitted through your provider. Step three, let us know. When you share your gift with us, again, as mentioned before, it allows us to thank you properly, acknowledge your generosity, and ensure that your gift is used according to your intent. And then step four is see your impact. We'll keep you updated once again on how your support is helping accelerate research, support patients, and drive progress across the NPM community. You don't have to wait to make a difference. Playing gifts can create immediate momentum, and you'll get to see that impact unfold. Now, all that said, what makes MPN Research Foundation a strong legacy partner? Because one of the most important questions when considering a legacy gift is, will it matter? Will it last? And at MPN Research Foundation, the answer is a resounding yes. We have a proven track record of turning donor generosity into real measurable progress. And as you can see here, many of the things that we've done over the last 25 years, where we've invested more than $20 million in research, funding 105 projects across 9 countries, supporting 99 researchers at 49 institutions. Every one of those dollars has been directed through a rigorous NIH-style peer-reviewed process that prioritizes bold, potential ideas while keeping patients at the center. So as we close, I want to invite you to take part in something powerful. This August, in honor of National Make a Will Month, we are launching the Legacy Challenge, which is a chance for you to take one simple but meaningful step. Create or update your will to include MPN Research Foundation. The thing is, you don't have to wait until August to do that. If you're ready to take that step today, we're ready to walk with you. And there are 3 easy ways to participate. Add us to your will, trust, or beneficiary designations. Let us know if we're already in your plans. We'd love to thank you and ensure your wishes are honored. And number 3, just start the conversation. Request our free plan giving guide. Again, that was put in the chat earlier, or schedule a time to talk with our team. If this mission matters to you, this is your moment. Your legacy can help fund the next major research breakthrough, support families facing an MPN diagnosis, and then push the entire field forward. You can make that impact now, and we're here to help you do it. So if you do have any questions, please do not hesitate to reach out. I can be reached directly at giving@mpnrf.org. And if you are a patient or a caregiver and have questions that we did not go over today, please feel free to email patientengagement@mpnrf.org. I want to again thank you again for being part of the MPN Research Foundation family, community, and for all of your time today. Have a good night. Thank you.